There's a story behind this that's worth telling. January 1st wasn't just another calendar flip this year. While most people were nursing hangovers and making resolutions they'd abandoned by February, a fundamental shift in global trade architecture went live. And silver, that volatile, schizophrenic metal that can't decide if it's money or an industrial commodity, found itself caught directly in the crosshairs. The tariff changes that kicked in weren't some minor policy tweak. We're talking about a restructuring of how precious metals flow across borders, how they're classified for import duties, and most critically, how foreign production gets priced against domestic capacity. The kind of shift that doesn't make headlines on CNBC, but absolutely should. What happened in the 48 hours after implementation tells you everything you need to know about how thinly traded and vulnerable this market really is. Silver futures saw swings that would have seemed dramatic over a month compressed into single trading sessions. Premiums on physical metal disconnected from spot prices in ways I haven't witnessed since the March 2020 chaos. Dealers started quoting spreads so wide you could drive a truck through them. And here's the thing nobody's properly explaining. This wasn't just about tariffs in isolation. The January 1st implementation landed on top of a market that was already structurally stressed, already dealing with supply constraints that the mainstream analysts keep downplaying, already facing an industrial demand profile that's fundamentally different than it was even 2 years ago. Let me walk you through what actually happened, why the timing couldn't have been worse, and what the institutional players are doing right now while retail investors are getting fed sanitized narratives about temporary volatility. The tariff framework that went into effect reclassifies certain silver imports based on their processing stage and country of origin. Sounds bureaucratic and boring, right? But when you've got a global supply chain where Mexican refineries process Peruvian concentrate, ship it to Canadian fabricators, who then export finished products to American manufacturers, suddenly every step in that chain is getting hit with different duty calculations. The immediate impact was predictable if you understood the flow. Import costs spiked. Not uniformly, that's what makes this tricky, but in specific categories that matter enormously to industrial users. Photovoltaics, silver for solar panels, silver powder for electronics. Manufacturing, certain alloy specifications for automotive applications. Now, here's where it gets interesting. The solar industry has been the fastest growing source of silver demand for the past 5 years. We're talking about consumption that went from barely registering to representing roughly 15% of total annual demand. These aren't luxury watches or investment coins that can absorb price increases and shrug them off. These are massive industrial operations running on razor-thin margins where every basis point matters. When tariff costs hit their imported silver supplies, manufacturers faced an immediate calculation problem. Do they eat the cost and destroy their margins? Do they pass it along and risk losing contracts to Chinese competitors who are not dealing with the same import structure? Or do they scramble to source domestically produced silver that suddenly looks more economically viable? The answer, as it turns out, was all three simultaneously across different companies. And that created a buying panic in specific segments of the physical market that most futures traders weren't even aware was happening. I started seeing it in the dealer networks first. Fabricators who normally order on predictable schedules suddenly placing urgent requests for immediate delivery. Refiners getting calls from customers who'd never bought domestic production before, asking about capacity and lead times. The kind of scramble that happens when procurement departments realize their existing supply chains just got significantly more expensive or uncertain. Think about that for a second. You've got industrial buyers who built entire operational frameworks around specific cost assumptions. Their budgets, their contracts, their competitive positioning, all based on being able to source silver at particular price points with reasonable certainty. Then overnight, that certainty evaporates. The spreadsheets stop working. The hedges don't cover what they thought they covered. That's when panic buying starts, not from investors speculating on price charts, but from companies that need physical metal to keep production lines running. And that's a fundamentally different kind of demand pressure. The futures market saw this coming, but didn't price it correctly. I watched the positioning data in the weeks leading up to January 1st, and it was clear the commercials were adjusting their hedges, but not aggressively enough. They were treating this like a policy change that would create some short-term disruption and then normalize. What they missed was the compounding effect. The tariffs didn't just change import economics. They landed on top of a supply situation that's tighter than the official statistics suggest. Let's talk about what's really happening with silver production, because this is where the narrative you're getting from mainstream sources starts to diverge sharply from reality. The major mining analytics firms publish these reports showing steady or slightly increasing global silver output. They point to new projects coming online, expansion at existing operations, technological improvements in extraction efficiency, all technically accurate, all fundamentally misleading about the actual available supply. Here's what they are not emphasizing. The The vast majority of silver production is a byproduct of mining other metals: zinc, lead, copper, gold. The silver comes along for the ride, which means silver output is actually determined by the economics and operational decisions around those primary metals, not by silver price itself. When copper production drops because of permitting issues, labor disputes, or declining ore grades, silver production falls with it. When gold mines reduce output due to cost pressures, their silver byproduct disappears too. The miners don't make decisions based on optimizing silver extraction. They're not even thinking about it that way. This brings us to the structural problem that's been building for years. As primary metal production faces increasing headwinds, more difficult geology, stricter environmental regulations, rising energy costs, nationalization risks in key producing countries, the byproduct silver gets squeezed without anyone specifically targeting silver supply. And unlike those primary metals, silver doesn't have enough dedicated primary production to make up the difference. There aren't vast numbers of pure silver mines that can ramp up when prices spike. The marginal supply that's supposed to respond to price signals largely does not exist in any meaningful volume. So you've got industrial demand that's been growing, particularly in the technology and green energy sectors. You've got investment demand that comes and goes in waves but keeps returning as currency concerns resurface. And you've got a supply profile that's constrained by factors mostly outside of silver market dynamics. Into this already tight situation, you drop a tariff structure that suddenly makes certain supply chains more expensive and less reliable. The pressure points were already there. January 1st just exposed them. The price action we saw wasn't irrational speculation. It was the market repricing risk. It was industrial buyers who thought they had supply certainty, realizing they didn't. It was traders who'd been short based on one set of assumptions, scrambling to cover when those assumptions broke. I want you to understand something about how professional traders think about silver. They don't approach it like gold, this stable store of value with steady, predictable behavior. They treat silver like a leveraged bet on industrial growth, with a precious metals kicker that occasionally dominates the narrative. That dual nature makes it incredibly difficult to model and hedge. When industrial demand is driving the price, you analyze it like copper, looking at manufacturing PMIs, construction data, technology sector growth. When monetary concerns take over, you analyze it like gold, watching real interest rates, dollar strength, inflation expectations. The problem is, the market can flip between these modes faster than most positioning can adjust. And tariff disruption hits the industrial side while simultaneously creating the exact kind of policy uncertainty that triggers the monetary safe haven buying. This is the moment where the technical traders running algorithmic systems got absolutely destroyed. Their models don't know how to process tariff implementation, creates industrial supply panic that then triggers safe haven buying from investors watching the chaos. The correlations their systems expect stop working. The support and resistance levels that were supposed to hold just evaporate. I saw stop-loss cascades that pushed prices through levels that should have had massive buy-side liquidity waiting. Those buyers should have stepped in and stabilized the market. But they didn't, because the liquidity was based on normal market conditions, and this wasn't normal. The algorithms pulled their bids. The market makers widened their spreads. And suddenly, there's no cushion between price levels. The whipsaw action, violent moves up followed by equally violent reversals, that's what happens when there's no stable buyer base providing consistent liquidity. Everyone's either panicking in or panicking out. Nobody's calmly providing the two-sided market that keeps things orderly. And here's what bothers me. The exchange officials and regulators saw this happening in real time and did nothing. No temporary trading halts, no expanded margin requirements to cool things down, no emergency liquidity provisions. They just let it run, let the volatility spike, let the weaker hands get stopped out and liquidated. Now maybe that's fine. Maybe that's just markets being markets, with all the brutal efficiency that implies. But it also suggests that the people supposedly overseeing these markets for fairness and stability were either asleep at the wheel or decided that protecting participants was not their priority. The physical market disconnection is what really concerns me going forward. In a functioning market, futures prices and physical prices should track reasonably close. There's always some premium for physical. You're paying for fabrication, distribution, dealer margins. But it's generally stable and predictable. What we saw after January 1st was premiums exploding, coins and bars that normally trade at $2 or $3 over spot suddenly carrying $8 or $10 premiums, delivery delays extending from days to weeks, dealers simply refusing to lock in prices for future delivery because they had no confidence in their own ability to source inventory. That's not a liquid, efficient market. That's a market under stress, where the paper price and the actual metal in your hand price are telling two different stories. And historically, when that divergence gets wide enough, something breaks. Either the physical market drives the paper price up to reflect actual scarcity, where the paper market crashes the physical premium by flooding the market with metal from inventories that are supposedly backing all those futures contracts. One way or another, the gap closes. The question is, which direction it goes and how violently. Think about that for a second. You've got futures traders betting on price direction based on charts and positioning data, and you've got industrial buyers desperately trying to secure physical metal because their supply chains are disrupted. These are completely different markets with completely different dynamics that happen to share a price reference point. When that price reference point stops serving both markets, when the futures price stops actually representing the cost of acquiring real metal for real delivery, that's when the system is telling you it's under fundamental stress. The January 1st tariff changes didn't create this vulnerability, they revealed it. The market was already functioning with leverage and liquidity assumptions that were fragile. The policy shift just proved how fragile. Now let's talk about what the big institutional players are doing, because it's not what you might expect. The commercials, the mining companies, the industrial users, the major market makers who supposedly know this market better than anyone, they've been aggressively adjusting their hedge positions, but not in a uniform direction. Some are massively increasing their hedges, locking in current prices for future production or consumption. Others are actually reducing hedges, seemingly willing to take naked exposure to price movements. That divergence tells you they don't have consensus about where this is heading. The smart money is split, and when the smart money is split, that's usually when you get the most violent price discovery process, because there's no dominant positioning that provides stability. The investment funds have been even more erratic. The big macro hedge funds that trade gold and silver as inflation hedges, they've been whipsawing their positions based on every data point about tariff impacts every statement. From policymakers, every shift in the dollar or real interest rates, there's no conviction, just reactive trading. And the retail investors? Most of them don't even know this is happening. They're watching their brokerage accounts show silver prices jumping around, maybe seeing some headlines about volatility, but not understanding the underlying supply chain disruption that's driving it. This is what you need to know. The tariff situation isn't getting resolved quickly. This isn't a policy that gets tweaked and normalized in a few weeks. The reclassification of import categories, the new duty structures, the compliance frameworks that companies have to build, that's a multi-month process of adjustment at minimum. More likely, it takes most of the year for new equilibriums to establish. During that adjustment period, you're going to continue seeing these pressure points where specific types of buyers need metal urgently and push prices around. You're going to see continued premium volatility in the physical market. You're going to see correlation breakdowns between silver and the assets it normally trades with. That creates opportunity if you understand what's happening and can tolerate the volatility. It creates danger if you're trading on autopilot based on historical patterns that are not relevant to the current dynamics. The solar industry situation is particularly worth watching. These manufacturers are facing a brutal calculation right now. Silver represents a significant cost in photovoltaic panel production, but it's absolutely essential. There's no substitute that works as efficiently. So when silver costs spike because of tariff impacts, they can't just switch to a different material. Some are absorbing the cost hit and watching their margins compress. Some are trying to pass costs to customers in a market that is already facing pressure from Chinese competition. Some are investigating silver recycling and recovery systems that weren't economically viable before but might be now. This demand destruction question is critical. If high silver prices and tariff impacts make solar installations less competitive economically, and solar demand softens as a result, that's a significant source of industrial silver demand that could reverse. That would be bearish for prices. But if solar deployment continues growing despite higher costs, maybe because of government subsidies, maybe because competing energy sources are also seeing cost increases, maybe because the green energy transition has enough political momentum to power through, then you've got that industrial demand staying strong or growing even at higher price levels. That's bullish. I don't have a crystal ball on which way that plays out. But I know that most analysts are making simplistic assumptions about price elasticity of demand that probably are not accurate for this sector at this moment in time. The electronics industry is facing similar questions with different specifics. Silver is critical in certain applications, switches, contacts, conductors, in specialized components, but the quantities per unit are often small enough that even significant silver price increases do not massively impact total product cost. An extra $20 in silver content on a component that goes into a product selling for thousands of dollars, the manufacturer barely notices. But an extra $20 across millions of units can still represent tens of millions in additional costs at the company level. So the procurement departments notice, even if the engineering departments don't care. What I'm watching is whether these industrial users start working harder on silver reduction strategies, using less silver per unit through design changes, developing alternative materials that might be slightly less effective but significantly cheaper, building recycling and recovery systems for silver from scrap and obsolete products. Those initiatives take time. You don't redesign complex electronic components or retool manufacturing processes overnight. But the January 1st tariff shock creates exactly the kind of urgency that makes executives approve projects that have been sitting on the back burner. If that happens at scale across multiple industries, it represents a structural shift in the demand profile that could take years to fully materialize, but would fundamentally change the market dynamics. The monetary side of silver demand is even trickier to forecast right now. Investment buying of physical silver, coins, bars, allocated accounts has been erratic. There's clearly some constituency of buyers who see economic uncertainty, policy instability, currency concerns, and respond by buying tangible assets, including precious metals. But the enthusiasm isn't universal, like it was in previous precious metal surges. Cryptocurrency has captured some of the alternative to fiat currency mindset that used to default to gold and silver. Stock markets keep grinding higher despite endless predictions of crashes. Real estate, despite affordability challenges, still represents where most people park long-term savings. Silver is competing for investment dollars in a way it didn't used to. The narrative that it's essential portfolio insurance has to work harder to convince people. Like what this all comes down to is a market that was already structurally tight, getting hit with a policy shock that exposed just how fragile the supply chains really are. The January 1st tariff implementation was massive in scope. We're not talking about the kind of trade war tariffs that fundamentally reshape global commerce, but it didn't need to be massive. The silver market is thin enough, leveraged enough, and complex enough that even modest disruptions cascade in ways that are difficult to control. The price panic we saw wasn't irrational. It was rational actors responding to real changes in their economic calculations. Industrial buyers facing higher costs and uncertain supply, traders covering positions that suddenly looked dangerous, physical dealers dealing with demand that overwhelmed their normal inventory systems. What happens from here depends on factors that are genuinely uncertain. How long does the supply chain adjustment take? Do industrial users find ways to reduce silver consumption in response to higher costs? Does investment demand accelerate if economic uncertainty increases? Do the futures markets regain stability or continue experiencing volatility spikes? I can tell you what the bullish case looks like. Industrial demand stays strong or grows, particularly from solar and electronics. Investment demand accelerates as currency and inflation concerns resurface. Supply stays constrained by byproduct dynamics and underinvestment in new production. The tariff disruption creates lasting structural changes that keep certain supply sources expensive or unavailable. Physical premiums stay elevated, eventually pulling futures prices higher to reflect actual replacement cost. That case gets you silver prices significantly higher over the next 12 to 18 months, with continued volatility along the way. The bearish case, industrial demand softens as high silver costs make certain applications less economically viable. Investment buying stays tepid as other assets remain more attractive. Supply responds more elastically than expected, with new production or recycling coming online. The tariff situation gets resolved or worked around more quickly than anticipated. Physical premiums compress back to normal levels. Futures prices reflect adequate available supply. That case probably keeps silver range-bound or slightly lower, testing the patience of anyone positioned for the explosive move higher. My read, for what it's worth, is that the market stays volatile and difficult with a bias toward higher prices over time. The supply situation is genuinely tight in ways that aren't easily fixed. The industrial demand profile has fundamentally shifted with the growth of technology and green energy applications. And the policy environment, not just tariffs, but broader economic and monetary policy, creates the kind of uncertainty that eventually drives people toward tangible assets. But getting from here to significantly higher prices isn't going to be a smooth ride. It's going to be volatile, frustrating, characterized by head-fake moves that stop out weak positioning and shake out uncertain holders. The kind of market that requires conviction and risk management in equal measure. The January 1st tariff shift was a catalyst that exposed existing vulnerabilities. It created immediate price panic that was justified by real supply chain disruption. And it set in motion adjustments across industrial and investment markets that will take months to fully play out. If you're positioned in this market, you need to understand you're not trading a stable, liquid commodity with predictable behavior. You're trading a schizophrenic asset that can't decide what it wants to be, in a market that's structurally fragile, at a moment when policy changes are creating real economic impacts that the mainstream coverage is barely addressing. That's not a reason to avoid it. But it is a reason to approach it with clear eyes about the actual risks and dynamics rather than whatever sanitized narrative the financial media is selling this week. The price moves we saw weren't the end of this story. They were the opening chapter of an adjustment process that's going to define how silver trades for the rest of this year at minimum. Pay attention to the physical market premiums. Watch how industrial buyers adjust their sourcing and consumption. monitor whether investment demand builds or stays dormant. And remember that markets under stress don't behave according